Good morning from cool and sunny Chicago, where the 6-3 Chicago Bears will face the 4-5 Minnesota Vikings at Soldier Field in Chicago in just a few hours. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, November 16th, 2025. In today's podcast, our focus is on the benchmark S&P 500, which, following an incredible 43% rise from its April 7th low in just 7 months, has twice tested and held a critical tactical support level within just the past 6 sessions. We'll identify this level and discuss why it's so important to the market here over the next week or two in just a few minutes. Meanwhile, many more strategic, critical relative performance trends are currently being tested. How these relationships are resolved over the next week or two is very likely to determine whether the April broad market advance continues into 2026 or if a broad market top is already in place at the late October highs. We'll identify these key relationships later on in the video. Before we get into the latest charts, data, and model updates, here's a little bit of information about us. Asbury Research is a registered investment advisor that has been providing both investment research and access to our 4 model portfolios via managed accounts to both individual and professional money managers since 2005, which makes this our 21st year in business. We have 2 levels of research service available. Number 1 is our flagship Asbury Premium for more serious investors, which includes the latest updates on all of our models and some personal instruction that we do via Zoom to show you how to implement our models and strategies into your own portfolio. We also have an entry-level Substack newsletter. I'm going to it right now. It's $25 a month, entry level. It does not include updates on all of our trading models, but offers selected reports and selected models from our premium research product at least 3 times a week. There's also a free version of the Substack newsletter. So if you like the Following the Money podcasts, if you watch our interviews around the internet, if you like our approach, I strongly suggest that you sign up for the free version of the Substack. It's a no-brainer. It's going to give you a lot of free information based on my 40 plus years of being in and around the financial markets. You can do that again right here at Asbury Research at Substack.com. Individual investors, financial advisors, and RIAs can also access the Asbury Research models and the model portfolios via managed accounts that are available through Charles Schwab. Financial advisors and RIAs can also have access to these 4 model portfolios through a TAMP, which is a turnkey asset management platform. If you're an RIA and you're interested in our models, you can contact us at asburyresearch.com. Go to the contact tab. We'll give you more information on that. Our approach. Billy Beane, if you've ever seen the movie Moneyball, starring Brad Pitt, who played Oakland A's general manager Billy Beane, Billy built a baseball lineup using quantitative metrics and changed baseball forever. He was with a team that didn't have a lot of money to spend. They hired some smart kids that were out of some Ivy League schools who quantitatively figured out how to find these obscure players that had really good quantitative numbers and build a baseball lineup out of them. This is essentially our idea. Both my kids were college baseball players, so a lot of how we look at life is through baseball. But this is kind of the approach that we took here, is let's build many models that do different things. Models like the Asbury 6, models like CPM, like CEF, which we're going to look at in just a minute. And then let's put these models together in different increments to build different model portfolios that will give us different desired risk-reward profiles looking backward. 3 of our 4 model portfolios, Asbury Aggressive, Asbury Balanced, and Asbury Conservative, are all outperforming the S&P 500 year to date. And all of them have smaller drawdowns, lower standard deviations, and lower betas. So again, contact us via the contact tab if you want a little bit more information, or you'd like to see a fact sheet on any of those model portfolios. Okay, let's get started in looking at current market conditions by moving over to the Asbury 6. So we're going to go to our research center, and that's the paywall for the premium research service. And here's the Asbury 6. What is the Asbury 6? It's a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. Again, the Moneyball approach. People have asked me a million times over the years, what's your favorite indicator? I don't have one because all of them have an Achilles heel. None of them work all the time. So we went through my favorite tactical tools that I got from the trading floor and afterwards and started to backtest them in sets of 3, in sets of 7, to see which kind of formed a team, which was a good lineup, if you will, where if 1 or 2 of those indicators was having a bad period or it wasn't working, the other ones would pick it up. So we're looking for diversity and looking to kind of form a team. This is what the Asbury 6 is, and it gives us a really big advantage because we don't bet on an indicator that's going through a bad period. We like to think of the A6 as kind of a daily EKG for the stock market because it's updated every day after the close, and it shows every little wiggle in terms of how healthy the market is or how unhealthy. Right now, 6 are red here, all 6 indicators. And note, they all turned on the 13th, 11/13. So last Thursday, it was a bad day for the market, and it turned the metric down. So what does that mean? It means that until it turns back to positive, which would be 4 or more of these would have to turn back to green, the market is vulnerable to a deeper decline. The next thing we're going to look at is our CPM. Now, our CPM is a model rather than an indicator. I've been trading it in my own account for a long time. And here it is. CPM is a completely data-driven dynamic stocks bonds allocation model that we built to be an alternative to the standard 60/40 portfolio. Most of you that have worked with an advisor before are probably aware of the 60/40 portfolio. It's kind of the benchmark, and the thinking of that is, the thought process behind that is we're going to ask you a bunch of questions as an advisor, and how you answer them is going to tell us what to have you invest in. And they'll ask you questions about your risk tolerance, when you want to retire, so on and so forth. They all seem to be variations of a 60/40 portfolio. May have a little gold in there. It may have a little international equities in there. But the problem is, and it's meant to be an all-weather allocation, whether the market's going up, down, or sideways. Problem with that is, like in 2022, for example, stocks and bonds both went down at the same time. So you had no protection. Here's a good kind of illustration of this. This is based on a back test, but AOR is an ETF that was built to track a 60/40 portfolio, emulate a 60/40 portfolio. That's in blue. Here's our CPM in green. This goes back to the inception of CPM, which is Q4 of 2017. And note the difference in performance. I could tell you the standard deviation's about the same, the drawdown's about the same, and the beta's about the same. But look at the difference in performance. It's almost double. So let's go back here to the website. CPM is designed to protect investor assets during a market decline, eliminate the large drawdowns, and reduce volatility in portfolios by moving assets into a short-term bond or into cash when conditions warrant that when they're weak. CPM has outperformed slightly outperformed the S&P this year, but with less than half the maximum drawdown, 6% lower standard deviation, and beta about half of the S&P. So you're getting S&P performance with almost half the risk. Right now, CPM is risk on. It's risk on as of October the 21st. It initially went to risk on after the decline early in the year on April the 24th. We moved out of the market on October the 10th. That was that huge range day, if you recall, in October 21st, and went back in. So we're currently risk on. So the A6 is telling us the market is weak internally. The CPM is meant to keep us in the market as long as possible, but to avoid the big drawdowns. So they're not arguing with each other, but continued weakness in the A6 is eventually going to result in a CPM signal that is going to take us to risk off. Let's go to SEAF. SEAF is our sector rotation model, and SEAF is meant to be a replacement for that part of your portfolio that stays in the market. Most people do not go to 100% cash. I don't go to 100% cash. I want to keep something in the market, and I do that via SEAF. And what SEAF does is SEAF measures the velocity of money moving around the 11 sector spiders, which we have here, which together are the S&P 500, and it ranks them from 1 to 11. 1 being the strongest asset flows in, 11 being the strongest asset flows out. So the lowest scores, composite scores between the 3 different time frames that we're tracking, are going to tell you what the best ones are. And right now, the best asset flows through the end of last week are from healthcare, energy, and financials. So that's the allocation now for the SEAF. We always are in the top 3, and we avoid the rest. And since inception in mid-2018, SEAF has significantly outperformed the S&P 500 on an annualized basis. It doesn't outperform every year, but it outperforms on the years where there's a breakaway sector or sectors in the S&P 500, also with better risk-adjusted numbers. Again, you can contact us for more details on some of the data on this by going over to the Contact tab up at the upper right. Next thing we're going to look at is our ETF ideas. We have a lot of subscribers who like to buy individual assets. So we track ETFs here. We do not track individual stocks. So we do this for ETFs. And what we do is we do a daily screen of about 6,600 ETFs for certain criteria that have to do with trend, relative performance, and asset flows. And there we go. And right now, we've got 4 that currently meet those criteria. And the final criteria, before we put these out as a live idea, is I subjectively look at them for risk reward. I want to buy something that's either starting to break out or is on a support level. I'm not buying anything that's into a resistance level. So I'm careful to make sure the risk reward subjectively is good, even though we already have trend, relative performance, and asset flows. So right now we have 4 of them that are open. The oldest of those is IBB, which is biotech. You can see we put out the idea on October the 16th, exactly a month ago. The initial target on this is 165. Here's our soft stop here at 159.42. And through Friday, we've got an 8% open trade profit, and we've outperformed the S&P by 5%. If we look at it on the chart, you can see here the white arrows is where we initiated the trade. So we've got 8% here, and we have 5% here in relative outperformance versus the S&P. So what we're watching for now is there's a resistance level here that we're testing that is the November lows from 2021. If we break through there, then that opens the door to a move close to 175 here. 175, 176, 177 is that range. And you can see we're testing it for the past 4 days. If we can get up above here, we should have another run. But I wanted to explain to you how we go about determining what we buy out of 6,600 ETFs. So looking back on these, over 30 months, 2.5 years, we've had 111 trades. 54% of them have made money. They've been profitable trades. Our average winning trade is 5.4%, and it lasts 18 trading days, all on average, which is 3 days shy of a business month. Our average losing trade is only 2.4%, and we're in those trades for 8 days, or about a week and a half on the calendar. So our ratio of average winning trades to average losing trade in terms of performance is 2.3 to 1. This is a repeatable recipe to continue to have a winning strategy when you're buying individual ETFs. And you can see our Sharpe ratio is extremely high, 1.7. So that's the process that we use for that. Next thing we're going to look at is our Keys to This Week report. We're going to go here. Let's go right here. We've already got it opened up. Keys to This Week is once a week, typically at the end of the week. And we probably look at 120 or more charts together, Jack and I. And we pull out 9 or 10 that we think are the most important to be aware of and the most appropriate to what's going on in the market right now. This is the S&P 500. We talked about that support level. It's right in here from 66.86 to 66.31. It's actually built based on a low that we set in the middle of October. If we break through 66.31 and the Asbury 6 remains red, and ideally the CPM moves to risk off, that tells us that we have a top here at the October highs and we're going into a correction. So that was one important thing I wanted to show you. The other thing is I talked about relative performance. Relative performance often leads broad market direction. The NASDAQ Composite Index here, this is the larger in terms of constituency of the two NASDAQs. It has more stocks in it. It's currently testing on a relative basis. Comp started outperforming the S&P 500 on a quarterly basis on May the 2nd. That gave us all of this strength in the overall market, including comp. Note that it was tested here in August and held. That gave us quite a good opportunity to buy here in the middle of August. It's testing that 63-day moving average or that quarterly relative outperformance trend now. If it fails, that's going to tell us we lost our leadership from technology, and that will be negative. This is XSD, which is one of several ETFs that track the semiconductors. Note that semis started outperforming SPY here on May the 9th. They're underperforming now as of the end of last week. That means we have lost leadership from semis. Semis often lead technology. So if semis continue to underperform the S&P 500 over the next week or so, it's likely to help to drag down the larger, the NASDAQs, the 100, and also the comp. This would mean we lost our leadership from big cap tech as well. This is value versus growth. Value has been underperforming since April the 24th, which is when our CPM initially went to risk on. CPM, let me state it this way, CPM went to risk on April the 24th. Meanwhile, value started outperforming growth on a 63-day basis at the same time. Why? Because growth is more of a risk on and risk appetite type of asset. Look what's happening now. Value is starting to outperform. Value is starting to outperform here, starting to outperform growth. If that stays, if that holds, and we continue to see that outperformance over the next 1 to 2 weeks, that's an indication that's another indication that the market is losing its risk appetite, and internally the market is starting to change its character towards one that you normally see when we're in a bear market or if we're going into a correction. The last one I'm going to show you here, this is a 21-day moving average down here. This is the AUM in the Qs, which track the NASDAQ 100. This is where the Mag 7 are. This is where a lot of the strength, a lot of the leadership for the move higher this week has been coming from. Note that, well, down here, this is a 21-day moving average underneath the daily AUM of QQQ. You could see that was tested on August the 1st and held tactical bottom in the Qs or in the NDX. September 2nd, we went through it just for a few days, and then we recovered, got back up above the 21-day in AUM. That was another place to buy. October 10th, same thing happened. So now we're November 13th. So I'm going to be watching that AUM really very carefully next week. If it starts expanding again, back up above the 21-day moving average, it means some new buying came in for large cap tech, and that could help us to come off those support levels in the S&P 500 and move to the next stage higher. Maybe go back and retest 7,000 or 6,950. If the opposite happens and we linger down here and more money starts coming out of, more AUM starts coming out of the Qs, that's another really big red flag for us. The Asbury 6, the CPM model, the CEF model, and our ETF trade ideas are all a part of Asbury Research's premium research service. Contact us via the contact tab to request information about service details and pricing. Finally, let's just take a quick look at our $25 a month Substack. So there's basically two products here. There's our weekly chart focus, which is very close to what I just showed you on Keys to This Week, which is a part of the premium service. So this is a once a week overview of what we think are the important things to pay attention to in terms of relative performance and asset flows. We've got investor sentiment here. We've got value versus growth. We have small, medium, and large for size. So that is one facet of it, and that is once a week. And the second thing is our SORT report. SORT report you get twice a week here in this product. And SORT report is kind of a big filter that looks at a wide swath of different assets: commodities, global equities, ex-US, the dollar, gold, emerging markets, interest rates, crude oil, US technology, small cap, and even crypto. And it looks at them for trend, relative performance, and money flows. Just as we spoke of earlier, it tells us which parts of the global market have positive trends and are outperforming their benchmarks and have positive asset flows, which means that there's new money coming in to push those ETFs higher. This is a very low-cost way where twice a week you can see where the opportunity lies, and from there you can drill down deeper and look at sectors, industry groups, or even individual stocks if you like, in those that are green all the way across. Right now, it's commodities, global equities, ex-US, and the US dollar. Those are the green all the way across. Again, this is also twice a week, and that's the Substack. So you've looked at a lot of our products. We went through a lot of research over the past, what are we at, 25 minutes now. And that's going to wrap up our latest Asbury Research Following the Money. The next one is tentatively scheduled 2 weeks from today on November the 30th. I hope to see you then. In the meantime, if you have any questions or want more info on any of the research models and model portfolios that we spoke of today, you know how to get us. AsburyResearch.com, and you use the contact tab. You can also phone us at 888-960-0005. Don't forget to like and subscribe. Have a wonderful Sunday, and go Bears.